I don't think it's time to panic quite yet, but we are approaching a time in history where we usually see a spike up in volatility. That's what we're going to talk about on today's Market Brief, amongst other stuff, such as a snapshot of what's going on in the market. We had a lot of data reported today. We're going to talk about that. We're going to get into some of the headlines that moved various stocks and the market as well. Upcoming economic calendar and earnings events. We're going to hop into the global markets where we're going to actually dive into that seasonality chart that I just discussed, market conditions and the expected moves going into this week and the trading session tomorrow. Let's get into it. All right, ladies and gentlemen, welcome back to the show. We had some mixed results on the board. We did definitely see some red. Technology did lead the way, and then we had basically the remaining 10 sectors in the S&P 500 down. So big tech led the way, and let me just show you, this is a lot of blood on the street. So what caused this? What were the headlines? What was the news? As you know, we had CPI, but some of the underlying intermarket stuff that we look at and pay so much attention to is what really drove today's price action. That of which is the 10-year yield, the 10-year note. We're looking at TNX. We saw a massive rip into that, almost pulling to an about 4.5%. And that was also seeing a big move in the trade-weighted dollar, looking at the Dixie here on the Thinkorswim platform. And why is that important? Well, we've been talking about the correlation. We've been saying that if the dollar is going to start rising along with the 10-year yield, it could put the brakes on the S&P 500. Whereas if the dollar were to come back down and the 10-year yield were to fall, like it did in this period over here, that really put the gas pedal down on the S&P 500. So we're kind of running into a period in time where we're getting that counter trend move in the dollar. If you look at the dollar, we were prepared for this. We had the bullish divergence. We were talking about how it's been seeing a series of lower highs and lower lows. We have this low, that low with that bullish divergence, and we're starting to see it break from this trend line. Does this mean we're going into a bull trend with the dollar? Our CTA is going to become buyers and this thing's going to rocket ship up? Look, I don't have those specific answers for you. What I can tell you right now, this is still just a counter trend bounce, right? We are still seeing a series of lower highs in this current context. So you have to treat it as such. In the short term, it is still a bear trend in the dollar. If you take a look at UUP, which is the bullish ETF for the dollar, we are approaching the upper monthly implied move. And as the yield broke out to a high today over here, seeing some nice volatility, I want to call out that the TLT, which is the bond ETF, has reached into its lower monthly implied move. Now, if you don't know what implied moves are what the market prices in as far as forward-looking risk. It's trying to handicap risk by looking into the options market. So that's what that is, and we're approaching that lower level now, while this is taking place, there's an interesting thing that took place with oil today, and that's the black line right here. Oil was down on the day, which tends to be a leading indicator for yields. So as yields shot up higher today, perhaps oil is signaling that, hey, we actually might see these back off in the very near future and or consolidate, which could mean that we might see a bounce here and around these levels with TLT, at least here in the very near future. Let's take a look at some of the market moving headlines today. As we already talked about, CPI showed inflation impact from Trump tariffs. Tariffs only played a small role in that rising inflation. We did see an uptick on a year-over-year change. We went to 2.7. That was headline CPI. However, if you take a look at that 2.7, the previous was 2.4, but it did come in line with consensus at 2.7. You can see inflation rate month over month. It did uptick as well, but it came in line with consensus. Now, it came under, the core inflation rate was actually under consensus at 2.9, but it's still uptick from 2.8. And then you could see the core inflation rate month over month. The consensus was 0.3. We came in under at 0.2. So that's decent signs there based off of what we are seeing on consensus. But more importantly, right, instead of building up narratives, what's the market pricing in? You can take a look here at the July probabilities of a rate cut and the probabilities of no rate cut increased there in July. Well, what about the next meeting there in September? September? Well, in September, our probabilities are still remaining higher for a 25 basis point cut. However, let's take a look here of what's stair-stepping, and that right there is the probabilities of no rate cut have actually increased for the month of September. So if you look out at a probabilities curve over here, you can see a 97% probability no rate cut is coming in July, and then you only have a coin toss of a probability for September, and then October and December, we're looking at 1 and then 2 rate cuts as it stands into the end of the year. We had the Fed speakers come out today. Fed Collins urged patience on these rates, says tariff may be more modest. They called for the Fed to remain actively patient amid uncertainty and warned that tariffs will drive core inflation near 3% by year end, noted that strong corporate balance sheets may soften tariff impact. So the Fed is saying that currently about that. And then also Barkin said that as well, kind of echoing that. If we look into earnings, these were taking place today. JPM, we did have a profit beat, but it was disappointing net interest income and high expense outlook. Overall, they didn't even budge. They were down 0.74% on the trading session and did not break one of those expected moves or didn't tag it. However, BlackRock revenue missed, inflows were underwhelming, and that was despite their record assets. We cracked through the market's expectations and went significantly lower there to almost this 2 standard deviation move. Wells Fargo also cracked underneath its expected move, and we closed not too far off from it, but they did lower guidance, and that had that weak NII weighed on those shares there for Wells Fargo. And then Bank of New Mellon, this is a chart of Citi, but they did outperform on revenue and NII. NII, once again, was the net interest income. Okay, moving on. What really held this market together? Well, there was some news for the semiconductors. There was NVIDIA's resumption of AI chips to China as part of the rare earths talks, and you can see NVIDIA popped up 4%, and being one of the largest market cap names in the entire world, or if not, it is the largest market cap name in the entire world by now. I think it hit 4 trillion in market cap. Yeah, this can definitely have an impact based off of just its implied volatility and market cap and weight in the S&P 500 and the Nasdaq 100 can really keep these markets together. And you can see we came up here to its upper monthly implied move, while Tesla, the top North American sales executive, leaves, and that was based off of reports by Wall Street Journal, which caused a little bit of volatility there. You see a little bit of a bounce back here in Tesla, but today shares were off 1.93%, rather unchanged so far on the current month. You may look at this and might see a little bear flag forming, but overall, from a month-to-date perspective, our risk that's expected to be priced in is quite large, and we have yet to tag any of those specific levels. If we take a look at what's upcoming tomorrow, we do have PPI data, so that's going to be heavily watched there. That comes an hour before the market opens up. We got industrial production as well. We get some crude numbers as well, and then we also have more Fed speak. With all that said, we also have to add on top that we have earnings being reported by various names. In the S&P 100, we do have basically banks, and then I think J&J would be the other name reporting there too as well in the S&P 100. And we will give you the expected moves that the market is pricing in for tomorrow's trading session there too as well for those names. Let's hop into the global markets. There was some news around China. Q2 GDP growth, 5.2% year over year. And then we also had June factories outbeat their forecast. Retail sales slowed. But if you take a look at the China ETF, such as FXI, we did see a nice pop up today, 1.98%. You can see a series of higher lows here. And then we're kind of breaking to, some breaking out of this tightness. And the upper monthly implied move is there at about $39. If you look at KWEB has been contracting. And today, we've got that big volume breakout over here and still a wide open range of risk being priced in by these specific markets. There was some news about a tariff in Indonesia. I believe it was a deal was made at about 19%, but I think it was kind of hit or miss, so I'm not 100% sure that this is settled in yet, but we did see some volume come in, but not much price movement overall there in Indonesia. Now, talking about the title of this video, how we're seeing some risk but maybe no need to necessarily panic yet. A lot of people will have been sharing this specific chart. This chart is of the JGB, Japan's JGP. And you can see here, it's actually really mirroring the US 30 year. There's a pretty strong correlation between the two. These charts, by the way, I pulled from the market year, so I didn't need to make them myself. And I found this data to be quite useful that they shared. But what they also shared here that I thought was really interesting, besides this correlation, is also looking at its correlation to the VIX. And one thing that they're pointing out here is that if you look at the VIX, which is the blue line, and then the Japan 30 year is the orange line, you can see that there are sometimes some correlations with spikes in the VIX after seeing a rise in the Japan 30 year. So if you look here, the Japan 30 year spiked. Shortly thereafter, the VIX spiked. Right here, we have the Japan 30 year spiking, and the VIX hasn't really spiked at all yet at this moment. And if you invert the Japan 30 year and you look at the S&P 500 in relation, I mean, this is basically same as looking at this chart, but now we're, putting in the S&P 500 here. You can see that inverted, you typically, once this falls or rises, right, because that's what it's technically doing, what is the S&P 500 they're doing shortly thereafter? And you can see, oh, what do you know? Volatility steps in this area. And then right now, S&P 500 is kind of flatlined, saw some volatility today, but the Japan 30 year is moving to a level that we haven't seen here for quite some time. Well, not that long, but that was around a level where we started to see volatility back into the S&P 500. And this all lines up with where we are now based off of seasonality of the VIX index, looking here into the middle to ending month of July, where you can get a potential spike in volatility, which causes maybe a potential little panic, right? But we will always be here to look at those key levels to where the market could come from, because as it stands in this current context and in this market, and why I'm saying really not to panic, is this could just be a simple pullback, consolidation, a shakeout, where we can start to look for more opportunities. And if you miss the entire move, maybe presents some opportunities to get into the market as well. Now, one other thing, an element that I wouldn't really necessarily be too worried about until is market conditions, because they're still positive, but I'm keeping a very close eye to see when those change. And as most of you know, I use two things to determine market conditions. I use a short-term signal, and then I also use a more impactful signal that has to do with dynamic hedging or dealers. And overall, right now, when I look at the net gamma of the market, we have a pretty large wall over here at 6,300. That's the level that we've been talking about that we can kind of go to, potentially accelerate, from, and then get pinned at or push away from. And I'm still, that's what we talked about on the prior video, I think yesterday. And what did we do today? Well, we gapped up, right? CPI, right? The market reacted positively to the NVIDIA news or the semiconductor news. It responded positively to the CPI print. But where did we open up? We opened up at that call wall where all that exposure was. So the market got rejected. And, interestingly enough, if you look at today, we gapped up and went down. And, yesterday price action, we gapped down and then we kind of crawled back up. So we're getting a lot of chop in a very, tight range once again that we kind of built over here for a while. Then we accelerated through it. And now we're kind of chopping around once again. Okay, so that's that 6,300 level to just be aware of. And then the really key level that I'm honing in on is that gamma flip line. And that's just in confluence of the lower weekly expected move in the S&P 500. But when we get below the gamma flip line, that is when dealers can sell into selling and buy into buying. So hedging activity changes, and that increases volatility, decreases liquidity. If we remain above it, you still look to buy the dip and sell the rip. That's when volatility decreases and liquidity there increases. Okay, and that's what we've been seeing. We've been above the gamma flip line for a while now. This is dynamic, by the way. It updates and changes. So it's not like we were under it over here. No, we've been above it for a minute now, and we haven't yet to be below it. So I'm always more cautious below that gamma flip line. When we take a look at the direction of the 5-day moving average, we're starting to get some warnings here on SPY, and we're getting them here on XBI. And then we have a little bit more significant ones on IWM and DI. What this is just the direction of a 5-day moving average. It's currently increasing, but price is currently below it. So just saying, hey, caution here, right? Because if we remain below it, right, it could potentially turn around our shorter term trends, and we could hit down at lower daily expected moves or lower weekly implied moves, or potentially even break that gamma flip line. Q's still holding green, and that could be because semiconductors really did hold these markets today. And as you can see, semiconductors kind of consolidated sideways and remain above that 5-day moving average. The other day we were yellow, but you can see that we quickly reclaimed that. And then XBI is yellow because it's still moving up. So just be aware what it might do if it remains below those specific lines. Okay, let's go into expected moves. If you want to screenshot the expected moves for earnings tomorrow, we have Goldman Sachs, Morgan Stanley, Bank of America, J&J. Those are the ones in the S&P 100 that are reporting. These are the expected moves. That's plus or minus. And then you have your upper level, your lower level, the 1 standard deviation move. And then you have your upper level and lower levels of your 2 sigma moves there as well. This was today's daily implied range. You can see that we actually did not even tag it. So the market did what the market forecasted today as far as expectations go. It closes within the range 68% of the time, right? 1 standard deviation. And we haven't even tagged the daily implied move. Well, if you look in the overnight session, which I pretty much just like to look at the cash market session, but I still do peep the overnight and then also the pre-market as well. But you can see that overnight, which I don't know where we're at this moment of recording, but we did tag into that daily implied move just shortly after the market closed. So tomorrow's expected move, we're looking at about 616 to about 618 down here for the lower level on SPY. And that's not too far off of the lower weekly implied move. And by the way, it's only Tuesday. We got some trading days left in the week to hit one of these weekly implied moves. And then we have our upper implied move at about 627 down to and around 626. So if you are trading this, there is a VWAP that I would say pay close attention to, and that's today's daily VWAP at the start of the cash market session. Why? Because we also reported data that happened to be important for the market. So there was a lot more volume on today's session. And right now, what do you notice? The 15-minute candle opened up. We got rejected from the daily. We came back. We got rejected from it. We came back. We got rejected from it. This line, it's currently declining. So, and that's also prices below the week to date, and also the 5-day moving average, and the 5-day moving average, and they're all converging in this area. So if we gap down tomorrow or start ripping back up or whatever the case is, be highly aware that these levels are overhead, especially look to see how price reaches back, if it does, to tag those levels, because it can get rejected and get pushed back down. I would feel a lot more comfortable now, right, getting back above these specific levels and having them turn back around and having price do something like that versus get rejected, put in lower highs, and then break further to the down. That's all I got for you on today's market brief. Hope it helps out, gives you some insight. I haven't mentioned my Patreon on today's video, but if you want to take a look at the links that I have there in the pinned comment, please do so. The Patreon, by the way, for those that don't know, I post everything in the Discord. So once you buy the Patreon and you get that situated, you sync your Discord up to Patreon. It's only $9 a month, has all types of benefits. Yeah, that's all.